Warren Buffett, how to multiply $1,000 to get rich fast during 2024 recession. Hey there fellow investors and tech enthusiasts, welcome back to another exciting episode of our YouTube channel. Today, we'll uncover strategies for utilizing Buffett's insights to increase your 1,000-fold wealth amidst the approaching 2024 economic downturn. Let's delve into the economic scenario of 2024, addressing concerns that arise when individuals contemplate the potential onset of a significant downturn. Contemplating scenarios like a potential World War III or a return to the Cold War may cross one's mind. Even amid such uncertainties, the stance remains resolute, the commitment to continue buying stocks persists. The upcoming year is shaping up to present significant challenges, with various economic indicators pointing towards an impending recession. Adhering to the wisdom of Warren Buffett, the approach is to be apprehensive when others display greed and assertive when others succumb to fear. Despite the daunting nature of the current period, astute investors can discern unique opportunities within the turbulence. History attests that recessions, though challenging, often unveil some of the most lucrative investment prospects, reflecting on the 2008 financial crisis, characterized by widespread panic and economic upheaval. Shrewd investors demonstrated the ability to identify and capitalize on undervalued assets. This success wasn't mere chance, it resulted from a profound comprehension of market cycles and the realization that economic downturns frequently give rise to undervalued investment opportunities. For instance, the stock market, experiencing a substantial decline during the crisis, offered discounted buying opportunities for fundamentally strong companies temporarily undervalued. As we approach 2024, similar trends are emerging. Global economic strains are evident, marked by key indicators signaling potential challenges. Consumer debt has reached unprecedented levels, global trade tensions introduce market uncertainties, and inflation rates are gradually rising, impacting purchasing power. This combination creates an environment conducive to a potential recession. However, for those seeking to invest or grow wealth, it implies that amid prevailing fear and pessimism, there are undiscovered opportunities. Buffett's strategy in such periods emphasizes value investing, identifying companies undervalued by the market yet possessing robust fundamentals and long-term growth potential. Furthermore, an anticipated recession may lead to lower asset prices, creating opportune moments to enter markets that would otherwise be prohibitively expensive. For instance, real estate might undergo a correction, offering more affordable entry points. The key lies in thorough research, transcending short-term market fluctuations. Caution is paramount in approaching recession-era investments. Success hinges on a clear understanding of risk tolerance and investment objectives. It's not about perfectly timing the market but making informed decisions rooted in sound financial principles. Now, let's explore intelligent ways to invest $1,000 during the 2024 recession. Warren Buffett consistently advocates for making intelligent investment choices, particularly during economic downturns. His famous advice, "Do not save what is left after spending, but spend what is left after saving," becomes crucial when deciding how to allocate a limited capital amount like $1,000 in a recession. During a recession, the market often features undervalued assets, presenting an opportunity for your $1,000 to make a significant impact. The key is to identify opportunities where others perceive despair. Consider examining stocks of companies with strong fundamentals, those with solid balance sheets, healthy cash flows, and competitive advantages in their industry. In a recession, these stocks may trade at prices well below their actual worth. Another prudent move could involve investing in index funds or ETFs, providing diversification crucial for managing risk in volatile market conditions. Buffett himself favors index funds for their low fees and diversification benefits. For a novice investor with $1,000, an S&P winking and tongue-poking smiley 500 index fund could be an excellent starting point, offering a stake in the top 500 US companies. Real estate is also worth exploring during a recession. Businesses in this sector often require a one-time purchase without continuous reinvestment challenges. Your $1,000 could be directed toward a down payment for a rental property or a real estate investment trust, providing exposure to real estate markets without requiring substantial capital. Additionally, consider the emerging field of digital assets, such as cryptocurrencies and blockchain technology. While higher risk is involved, allocating a small portion of your $1,000 to this sector could yield substantial rewards over the long term. It's crucial to bear in mind that investing $1,000 during a recession demands patience and a long-term perspective. The goal is not quick profits, but investing in assets poised for long-term growth. As Buffett advises, our favorite holding period is forever. Treat your $1,000 as seed money for your future financial garden. Plant it wisely, nurture it, and watch it grow over time. Now, let's delve into some practical calculations to enhance our understanding of investing $1,000 during the 2024 recession. Warren Buffett, renowned for his analytical approach, consistently emphasizes the significance of understanding the numbers when making investment decisions. He advises against investing in businesses one cannot comprehend. Considering the potential of the gold market, Buffett, with a nuanced perspective, often focuses on productive assets but acknowledges gold's value as a hedge against inflation and economic uncertainty. Investing in gold, particularly during turbulent times like a recession, can be a prudent move. Historically, gold has served as a safe haven during economic instability. With your $1,000, you could invest in physical gold, such as coins or bullion, or choose gold ETFs, exchange-traded funds, for easier liquidity without the need for physical storage. The decision between physical assets and market-traded ones depends on your preference. The return on a gold investment varies based on market conditions. For instance, during the 2008 financial crisis, gold prices experienced a significant surge. Historical data indicates an increase from around $800 per ounce at the start of 2008 to over $1,200 per ounce by 2010, representing a 50% growth. Applying a similar pattern to a $1,000 investment during the potential 2024 recession, it could potentially grow to $1,500. While gold doesn't offer dividends or interest, its value often appreciates over time, particularly during economic downturns. It serves as a long-term investment, diversifying your portfolio and providing protection against inflation. The key is to stay vigilant, as gold prices can be influenced by various global factors. In summary, investing your $1,000 in the gold market can be a strategic defensive move during a recession, offering a hedge against market volatility and inflation, a strategy aligned with Buffett's principles of understanding and prudently navigating market uncertainties. The question now is, are you considering gold as a part of your investment strategy? And how will you balance it with other assets to optimize your portfolio's performance? Redefining the approach to investing your $1,000, let's consider an often overlooked, yet potentially lucrative avenue. Investing in yourself by learning a new skill. Warren Buffett himself has emphasized the value of self-improvement, stating, "The most important investment you can make is in yourself." Let's explore how this investment can yield substantial returns. Supported by data from platforms like Glassdoor, Indeed, and LinkedIn. Suppose you use your $1,000 to enroll in a course or training program in a high-demand field such as digital marketing, coding, data analysis, or graphic design. The cost of such courses varies, but many comprehensible programs are available within this budget. Upon completion of your training, the increase in your skill set can significantly boost your employability and earning potential. For example, according to Glassdoor, the average annual salary for a digital marketer in the United States is around $57,000 per year, while entry-level coders can earn an average of $60,000 annually. Data analysis and graphic designers also see similar competitive starting salaries. The return on investment for such skill development can be substantial. If your new skills lead to a job paying $57,000 annually, compared to a previous salary of $40,000, that's a $17,000 increase in yearly income. Over a 10-year period, this equates to $170,000 return on your initial $1,000 investment in education, not accounting for potential raises and promotions. Beyond the direct financial gains, investing in skill development offers other benefits. It enhances your job security, opens up new career opportunities, and can lead to greater job satisfaction. Furthermore, skills like coding or digital marketing can provide avenues for freelance work, adding an additional stream of income. Investing your $1,000 in skill development aligns with Warren Buffett's philosophy of investing in oneself, potentially leading to significant financial returns and career growth. The next step is to determine which skill to cultivate and how to leverage it for maximum financial gains in the years to come. Transitioning from investment choices, let's delve into the power of compound interest, a concept Warren Buffett regards as one of the most crucial aspects of investing. Buffett famously attributed his wealth to living in America, having fortunate genes, and the impact of compound interest. Understanding this principle becomes especially vital when working with a modest sum like $1,000 during a recession. In simple terms, compound interest is interest on your interest. It's the mechanism where the value of an investment grows exponentially over time because the interest earned accumulates not only on the initial principal amount but also on the previously earned interest. This concept serves as a potent tool in an investor's arsenal, particularly during economic downturns when every dollar's impact is significant. Let's apply this to your $1,000 investment. Assuming you've diversified your portfolio, as discussed earlier, and you achieve an average annual return of 7% in the first year, your investment grows by $70, bringing the total to $1,070. In the second year, you earn interest on the new amount, so 7% of $1,070 is approximately $74.90, making your investment worth around $1,144.90. This compounding process continues each year, causing the amount to grow progressively larger. Over a more extended period, this growth becomes more pronounced. After 10 years, with a consistent 7% return, your initial $1,000 could grow to about $1,967.15, nearly doubling your investment. This calculation vividly illustrates how compound interest accelerates the growth of your investment over time. Even during a recession, when investment returns may fluctuate, the principle of compound interest remains a beacon of hope. It encourages long-term investment strategies and patience, perfectly aligning with Warren Buffett's investment philosophy that prioritizes steady growth over quick gains. Looking ahead, let's shift our focus to diversification and risk management, vital strategies during economic downturns. Warren Buffett, with a history of successful investing, is a proponent of diversifying investments. He once remarked, "Diversification is protection against ignorance." It makes very little sense for those who know what they're doing. While this might imply a preference for concentrated investments, it also underscores the importance of understanding and managing risk, especially with a limited sum like $1,000. Historically, diversification has proven to be key to resilience during recessions. For instance, during the dot-com bubble burst in the early 2000s, investors with diversified portfolios were better shielded from the dramatic downturn in the tech sector. Similarly, in the 2008 financial crisis, those who spread their investments across various asset classes, including stocks, bonds, and commodities, experienced less volatility compared to those heavily invested in real estate or financial stocks alone. For your $1,000 investment in the 2024 recession, diversification means avoiding putting all your money into one stock or one sector. It involves spreading your investment across different assets, including a mix of stocks from various sectors, bonds, and perhaps a small portion in emerging markets or alternative investments. This approach helps mitigate risks and enhances the potential for more stable and consistent returns over the long term. Balancing risk through diversification is a crucial strategy. If one asset class underperforms, others may compensate, enhancing the overall stability of your portfolio. As we approach the final chapter, it's essential to underscore the significance of adopting a long-term perspective in investing, especially during the 2024 recession. Warren Buffett's enduring success is largely attributed to his unwavering focus on the long term, as he famously stated, "Our favorite holding period is forever." This approach becomes pivotal when investing your $1,000, considering that short-term market fluctuations can be misleading. Historical records consistently demonstrate that patience pays off in the investment world. For example, during the 2008 financial crisis, investors who held onto their investments and resisted panic-driven selling generally witnessed their portfolios recover and grow in the subsequent years. The key lesson is endurance. In 2008, the S&P winking and tongue-poking smiley 500 experienced a significant drop, but by 2010, it had begun to rebound. Investors who maintained a long-term view and continued to invest, even in small amounts during the downturn, capitalized on the market's eventual recovery. The challenge lies in deciding if you can uphold this long-term perspective and stay the course, even when faced with adversity. In conclusion, navigating the 2024 recession with a $1,000 investment demands a combination of strategic thinking, patience, and a long-term outlook, guided by Warren Buffett's enduring wisdom. Remember, the greatest opportunities often emerge in times of uncertainty. How will you apply these strategies to grow your investment during the recession? Feel free to share your thoughts and plans in the comments below. Let's engage in a discussion on turning challenges into opportunities in these turbulent economic times. Don't forget to hit like and subscribe to our channel for more updates. Thank you for joining us in this video, and we hope to see you in the next one. Happy investing!